Welcome to Tycoons of Small Biz, a podcast designed for small business owners, the backbone of the American economy. Join us as our hosts Austin and Landon share insights and experiences as small business owners, active investors and operators who have started, bought, sold, and grown several successful businesses. Tycoons is powered by Backbone Planning Partners, a business consulting and wealth management firm built specifically to serve small and medium-sized businesses.
Hello, Tycoons, and welcome to today's episode of Tycoons of Small Biz. I'm your host here, as always, Austin Peterson, coming to you live from Gilbert, Arizona, and Landon Mance, my co-host, coming to you live from Las Vegas, Nevada. Landon, welcome in.
Thank you, sir. Good morning.
You excited as I am to talk about private equity and private placements?
Tickled pink, sir. Tickled pink.
All right, so let me just kind of introduce this here. So for those of you listening, we're going to talk about private equity funds and private placements. And here's the thing: I've been doing what Landon and I do for about 24 years, focused solely on business owners for the last, call it 5 or 6 years completely. And I hear often, and I know you do, Landon, as well, that private business owners are not usually, or I shouldn't say even usually, but oftentimes are not super big fans of public markets, right? So think of the S&P 500, think about Microsoft, Amazon, Google, all these stocks that are out there, et cetera, et cetera. Those are the public markets. And what I hear often from them is, I don't get it. I don't understand it. I feel it's like this ethereal thing that's just kind of out there. They just dictate whatever price, and the market kind of pushes the price up or pushes the price down, and they respond to certain things in the news. I don't like it. I'm building my business. I understand it. I'm comfortable with it. That's where I invest.
Yeah, no doubt about it. We hear that. Yeah, I mean, we hear that all the time from prospective clients, that we're talking to, from existing clients. I think undoubtedly business owners understand that that's an important part, of a portfolio, but they also, have built something kind of with their own two hands, if you will. And so they also really like the idea of kind of having more tangible aspects to their portfolio, i.e. other small businesses, real estate. We've got clients that have, car collections and cash. Certainly Austin and I had a conversation with a person the other day, and, they've got $500,000 of cash that sits in their safe. And that is not uncommon. We have conversations quite frequently with business owners where they're like, oh yeah, I've got 50 grand. I've got 100 grand, apparently 500 grand, sitting in their safes. So they like tangible stuff that they can feel and touch and move around and just kind of have that control over.
Yeah. Well, and that 500,000 in cash doesn't include the $1 million in physical gold and silver that they have in addition to that. So
yeah, that's true.
Yeah. All right. So yeah, I mean, that kind of tees us up for what we're talking about today. So, it's kind of in the name, but let's, we just talked about those being the public markets or the public equity markets. So contrast public equity with private equity for us.
Yeah. For sure. So I wonder if it's a little bit more productive to just talk about why people should consider it. So I'll just lay a little bit of groundwork for a minute or two. The private marketplace, okay, I'll just use that as a very general term that covers private equity and private real estate and private placements and all kinds of alternative investments. the private marketplace has, I would say, blown up, the last 3 to 5 years, but really, let's just call it over the last decade, but more specifically, the last 3 to 5 years, where, it used to be kind of like a who type of deal, where you could get into stuff, but only if you knew the right people and had the right connections. And now that's just not the case. There's syndications and crowdfunding and small private funds. And so the marketplace has become significantly more accessible the last, 3 to 5 years, to where now there's even, there's stuff popping up like secondaries, where people get into private stuff and they want to exit out of it for some reason. So now there's even marketplaces to buy other people's interest in private deals. So the marketplace is just absolutely blown up, and we're just going to continue to see it get more and more robust and efficient, over the years to come. So it's a really important piece to the puzzle. People are really starting to see that, and so the marketplace is reacting to the demands of investors, and so we're starting to see it, change significantly. Okay, so contrasting public markets and the private marketplace. So I think everybody listening to this knows, right? The public marketplace. Why do people invest there? Okay, well, it's easily accessible. So through a financial advisor or through a Charles Schwab or a Fidelity, there's all kinds of platforms now where you can access the public market investments, stocks, bonds, mutual funds, exchange traded funds. Those are going to be the big four, if you will. And they are generally going to be liquid, meaning that you can trade, aka buy or sell in and out of those, generally at the click of a mouse. So they're liquid, and anything that is that liquid, the risk goes down. So they generally are going to be less risky than private stuff in the private marketplace. So in the private marketplace, even though stuff is becoming more liquid, I mentioned the secondaries platforms that are now starting to come live, but generally stuff in the private marketplace is illiquid, meaning that you can't just click a mouse and get to your money. If anything, you've got to wait around for a process, or it just may be completely illiquid, meaning that you have got to hold something until there's some kind of a transaction that occurs that's probably out of your control. So generally illiquid, significantly less accessible than the public market space. So to get into some private deals, you've got to have $250,000, and some you've got to have millions and millions and millions, of dollars. So just depending on what you're getting into. So those are the main differences that I think are glaring. But anything you want to add there?
Yeah, a couple things I'll add. It's interesting. The public markets have been around for a long time, right? I mean, everybody kind of is familiar with the S&P 500 or the Dow Jones or, NASDAQ, et cetera, et cetera. And you mentioned that they're liquid, but, the reality is there's a price or a value given to those holdings every single day, right? And throughout the day. Those prices change throughout the day. And that's just not the case with a private deal where, you're buying it based on a future value, a future exit value. Maybe there's some income that's provided along the way, depending on the structure of the actual investment that you're in. But you're typically holding that, like you said, for a long period of time and, hoping or assuming that you're going to get your rate of return that was expected over that period of time. Now, what's interesting is, I've got a few statistics here, is between 1997 and 2016, the number of publicly listed US companies shrunk by over 50%, went from 7,509 companies to just 3,618. So you're seeing this kind of shift towards the private markets and away from the public markets, for a lot of different reasons, right? I mean, companies are choosing to not go public. Companies are seeing the opportunity or the reason to stay private or to become part of a private equity roll up, or, a lot of different ways that they can actually continue to grow the company. And at the same time, private equity assets under management have quadrupled over the past decade, from 2.2 trillion in December 2011 to nearly 8.3 trillion as of December 2021. So that's the most recent that we've got, but I can almost assure you that it's over 10 trillion in private equity money today. So the market is continuing to expand. Like you said, the access to it, the marketplaces that are being created, the opportunity to co-invest, right, with a lot of different people, to have that almost online marketplace feel that exists in a Robinhood or a Betterment or, Wealthfront, Vanguard, the different things that you mentioned there, to be able to have access to private equity deals just as easily, right? Still not as liquid, but just as easily as you can the public markets.
Mm-hmm. Yeah. Yeah, I saw that as of 2020, there was about 4,500 private equity firms and about 16,000 private equity-backed companies. So pretty large number. And the amount of private equity funds are growing rapidly. There's really been this big movement in the last several years around people and groups of people going out and buying, small businesses. And, that's something that we're getting into as well. So it's the demand for that is just going to continue to rise over time, without a doubt.
Yeah, no doubt about it. So real quick, let's just kind of define or talk about private placements real quick, and the difference, I guess, really between private equity and private placements. You want to hit that for us?
Yeah, for sure. So I'll start with a private equity fund. A private equity fund is going to be a vehicle that is put together, and that vehicle is going to be a pool of monies. The general partners of a private equity fund are going to be the decision makers, and essentially they're going to be choosing the investments to go out and make on behalf of what are called limited partners. Limited partners in a private equity fund are generally just going to be the investors. So they don't have any say or control over what is being invested in, but they are investing alongside other limited partners to pool their capital together so that the managing partners can go out and make investments. Now, the minimum investment to get into a private equity fund varies drastically. It can be as low as maybe 50 to 100 grand, and it can be as high as I think there's private equity funds out there that have a minimum of like $50 or $100 million to get into, and those are going to be the big institutions and endowments, billionaires, ultra high net worth, people that have that kind of capital. And when a limited partner puts their money into a private equity fund, they can expect that money to be locked up for as short as 3 to 5 years, and as long as maybe 10 to 20 years. But generally, private equity funds, you're going to be looking at a shelf life of the fund between 3 and 10 years. That's going to be standard. And these general partners are going out and they are buying private companies. Generally, they're buying them in their whole, but sometimes they are just making investments into these companies. Some make minority investments. That's more rare. Most of them are making a majority investment so that they have control, or they're just buying the company out in its totality. Now, one of the interesting things about private equity is that when they are buying a private company, they are generally requiring the selling individuals or entity to roll equity over into the new fund, meaning that if Austin and I are selling our private company to a private equity fund for $50 million, well, they're not going to be giving us $50 million in cash. That happens, but very, very rarely. So they're going to give us $50 million in consideration, and maybe they give us, $30 million in cash, and they ask us to roll over, $10 million of equity into the new company, the new fund or the new kind of holding company. And then maybe they want us to have some kind of an earn-out, which means that we get paid the remainder of the monies, assuming that the company kind of maintains its revenue and profitability. Maybe even have an opportunity to earn some more if it outperforms. And then at some point in the future, that private equity fund is going to flip over, or it's going to transact, and it's going to sell to another party. And at that point, we have another liquidity event, meaning that, we rolled over this, $10 million of equity into this new fund or this new company, and they hopefully grow the individual company that we sold them, or a collection of companies, and then they sell those for a higher valuation, and we get to realize what is generally referred to as a second bite of the apple. And sometimes that can be the same or potentially even more than what we originally got in consideration for the first transaction. So does that kind of summarize what a private equity fund is for the most part?
Yep. Yeah, no, I think that makes it pretty clear for, somebody out there who's thinking that maybe they're going to sell their business to a private equity firm in the future, as to how that works and how the funds, operate. So yeah, I think that's great. So what's the difference between that and a private placement?
Yeah, for sure. All right. I'll try to make this a little more concise. All right. So think of there's lots of different kinds of private placements, but just to kind of try to summarize what a private placement is, think about a company that is going to, they're looking to achieve a certain objective. Maybe it is to raise equity, or to raise debt, or to have some kind of another transaction. And they are going to go out into the private marketplace, and they are going to construct an offering, and they're going to bring that offering out to the private marketplace in order to try to achieve the objective that they are trying to achieve. For the most part, to invest into a private placement, you have to be, same goes for a private equity fund, I should mention, you have to be an accredited investor, meaning that according to the Securities and Exchange Commission, you have to be deemed an accredited investor, which means you got to meet an income requirement, or you have to meet a net worth requirement. And you can just Google that and look it up yourself if you're curious what those are. Or you can be a licensed investment professional like Austin and I, and that automatically kind of pushes you into the accredited investor bucket. And then there's a few other prerequisites that you can meet in order to be considered, an accredited investor. But again, you can kind of look those up. And then you will buy a certain allotment, of that private placement. And the goal is for them to raise the debt or the equity or to achieve a specific objective based on what they're setting out to do.
Yeah. So the real difference is that with a private placement, they're setting the plan ahead of time. We're raising this much money, and we're going to go out until we've raised that much money. And a private equity fund may say, we're looking to raise this much money, but there's not really a cap on what they're doing inside of a private equity fund. The private placement, they have a goal that they're right. It may be we're buying this apartment building for X, and then we need to spend X to rehab it and get it ready, to rent at that point. And in order to do that, we need this much money. And so they sell interest in that private placement so that they can do that. And then they may operate it for a few years and then sell it at a profit, right? So there's a lot of different ways that can actually come to fruition. But that main difference is we've got a budget, so to speak, that we're meeting, and we're going out looking for individual and accredited investors in order to be able to achieve that number.
Yeah, that's a great example, because with let's say a company is going to go out and buy, I think you said an apartment complex or something. So a company is going to go out and buy an apartment complex. They may, so they're going to have a capital stack, right? And part of that capital stack might be debt, and then there's different kinds of debt. So there's, like a mezzanine kind of short-term debt. There's private credit. There is a traditional, bank loans. So their capital stack may have different elements of debt and equity, and they may do private placements for each of those kind of components, right? To raise equity, to raise debt, maybe it's for short term, and then maybe that short-term debt might convert into something else. But that's a good example, because you can use different private placements for different objectives for the same project, potentially.
Yep. Yeah, absolutely. All right. So just a couple of things that I'll mention real quick, pros and cons. We've kind of already hit some of those, right? So a con is that it's illiquid. These types of investments are illiquid. It's not something that you can get access to your money on a moment's or a day's or even, a month's notice. You may not have access to this for many, many years, right? I always just kind of have in the back of my mind and just kind of tell most investors with most private placements or private equity funds to plan on it being about a 7-year investment, right? You said 3 to 10, so it can be shorter, of course, but if you plan on it being 7, you're going to kind of be prepared for that. So you're putting that money aside. Well, a pro to that is that if you look historically over the last, call it 15 years, private equity funds have outperformed the public equity markets, both on the large cap and on the small cap, right? So does that mean that we put all of our money in private equity investments? No, of course not, right? I mean, we shouldn't none of us should be looking at all of our eggs in one basket, period, regardless of the type of investment. But because you're taking on greater risk with lesser known companies and it's illiquid, you're going to expect that your return is going to be greater. Right? So it should be a part of people's investment portfolios, not their entire investment portfolio. Even like I've talked in the past, like if you only have investments in your own business, you're doing the exact same thing, right? You may not think that you're taking on additional risk because it's your business, you run it, you understand it, you feel comfortable with it, but your risk is greater because all of your eggs are literally in one basket. So diversification is key, period. But over the last 15 years, as these have really come online and become a really larger part of the overall investment markets, they are outperforming public equities.
Yeah, for sure. And this is going to be situational, of course. Okay, so anybody that's listening to this, don't take this as, as what we recommend or suggest, because it is very much situational on a case by case basis for people. But when we look at private equity, which is not just private equity funds, but private equity is also, real estate stuff and other, small business investments. And so when you look at private equity, private placements, and I'll go broader and just say the private marketplace once again, a good rule of thumb is no more than 20% of your investable assets should go into the private marketplace. So for example, if you have $1 million to invest, we're not talking about $1 million of net worth. We're talking about $1 million of investable assets. A good rule of thumb is no more than about 20% should go into the private marketplace, because for all the reasons that we've listed, much higher degree of risk, no liquidity. So something happens in your life and you need to get to a big chunk of money. Well, if it's locked up in some kind of, a private marketplace deal, good luck to you, because you're probably not going to be able to get to that money, if something was to happen. That's why if you've got $1 million investment portfolio and you've only got 200 grand invested into the private marketplace, well, you've got 800 grand that's hopefully in much more accessible, liquid type investments that you can get to at, the drop of a dime.
Yep. No doubt about it. And the same holds true with your own business, right? You've got to view your own business as a part of the private markets. If you reinvest everything that you have liquid right back into your business to continue to grow it, and then something comes up and you've had a low billing month or whatever the case may be, and you don't have access to capital inside of your business either, right? So it's important to find a balance in everything that you do.
Yep. No doubt about it. I mean, I can't count how many times it's happened, even with our own clients, where we've got clients that have, $5, 10, $20 million a year revenue businesses, very successful by all measures. But something happens, COVID, government regulation, interest rates, going up, just whatever. I mean, there's a million things that can happen in small business, as we all know. And these very successful businesses, run into a situation where, they're essentially out of cash, just from proper, from improper planning, or just something that happens totally out of their control. And so this, it's a great point. The same rings true inside of our businesses, y'all, is that we got to have accessible monies that we can get to very easily, because things happen, and sometimes they're in our control and sometimes they're totally out of our control. But having that safety net of several months of expenses in cash that you can access very quickly is paramount, because again, we've seen it happen to very successful businesses that never saw it coming.
Yep. No doubt about it. All right. We're getting up against time. So if you want to just talk real quick about, what we've got on the horizon in terms of private equity investments and what the plan is here. Take the last couple of minutes to talk about that. Yeah, for sure. Without throwing in a shameless plug, but also being very, aware of, regulations. One of the things that we are focused on right now is putting together an opportunity for the small business owner community, primarily the clients that we serve and kind of our network, to go out and to support other small business owners, through investments and acquisitions, and
in doing so in a way that is really focused on kind of building a community of entrepreneurs, kind of by entrepreneurs for entrepreneurs, and going out and finding some really good small businesses to invest in, to acquire, and to continue on the legacy, from the entrepreneurs or the founders that started it. So that's something that we are focused on right now, bringing out to the marketplace ourselves. So we'll be excited to make some announcements around that here in the very near future. But just some closing thoughts for me would be the private marketplace can be a very lucrative place, to invest. A lot of people don't really understand it. There's tens and tens and tens of thousands of private, investments out there in the marketplace. So it's the waters can be murky. So just tread lightly as you start to invest in the private marketplace. But there are some really, really good opportunities out there in real estate, in small business, in private credit. So just continue to kind of keep your eyes peeled in that space, because it's just going to continue to get more efficient, and the offerings will continue to get better and better over time. But there's also a tremendous amount of risk in that space as well. So just make sure you continue to consider and weigh the pros and the cons, and do your homework, do your due diligence on anything, so that you're kind of going into stuff eyes wide open.
Yeah, no, I think that's some great feedback. I would, maybe add to that in stating that, these markets are large. There's a lot of people out there forming different funds that may just not have the expertise that they need to be able to do that. Right. And so it's important to know what it is that you're getting into, being able to do that due diligence. And if you don't feel comfortable being able to do it yourself, you should be looking to a professional to help you with that. Mm-hmm. Right. So, I mean, it could be a CPA who's comfortable due diligencing certain things. It could be a financial advisor who's comfortable due diligencing those types of investments for you. But you've got to make sure that part is bundled up. And if you're working with a financial advisor, for example, who only works in the public markets, that should be a red flag. If you have a financial advisor who only works in the private markets, that should be a red flag, right? The reality is it should be both. And so, you got to make sure that you've got somebody that you're working with that knows both sides of the markets, when to employ both, how they work for you, and how they fit into your overall portfolio and your personal financial plan. And if you don't have that, you should be looking elsewhere to try to find that, or, maybe you just haven't asked the right questions, or your advisor doesn't believe that you'd be interested in the private markets, for example. But it's a conversation that should be had with the advisor that you're working with. And if you don't have one that's doing that, then I would argue that they're not representing the full availability of funds that are out there and giving you the best opportunity to meet your financial objectives.
Mic drop.
All right. Well, we are at the end of time. We appreciate you listening in. We look forward to covering many more topics that are extremely pertinent to business owners, and look forward to the future. So thanks for joining us today.
Yep. Thanks for joining us.
You've been listening to Tycoons of Small Biz, a podcast for small business owners by small business owners. Be sure to follow us on our social media channels for links to all our episodes and great content around growing, investing in, buying, and selling small businesses. This podcast is distributed for informational purposes only. Statements made in the podcast are not to be construed as personalized investment or financial planning advice, may not be suitable for everyone, and should not be considered as solicitation to engage in any particular investing or planning strategy. Listeners should conduct their own review and exercise judgment, or consult with their professional financial advisor to see how the information contained in this podcast may apply to their own individual circumstances. All investing involves risk of loss, including the possible loss of principal. Past performance does not guarantee future results, and nothing in this podcast should be construed as a guarantee of any specific outcome or profit. All market indices discussed are unmanaged, do not incur management fees, costs, and expenses, and cannot be invested into directly. Investment advisory services offered by Backbone Planning Partners, LLC. Neither Backbone Planning Partners, LLC, nor its representatives provide legal or accounting advice. The content of this podcast represents the views and opinions of Austin Peterson and Landon Mance, and/or the podcast guest, and do not necessarily represent the views or opinions of Backbone Planning Partners, LLC. Statements made in this podcast are subject to change without notice. Neither Backbone Planning Partners, LLC, nor its representatives, the podcast host, or its guests have an obligation to provide revised statements in the event